Today we'll be presenting on our market outlook for the equity space, and the title for it is optimistic yet cautious, positioning for phase transitions. And I think this title kind of sums up in a whole kind of where our mood is right now. In general, we are still relatively positive, although there's quite a number of risky factors that are emerging, as well as scary news titles basically. But at the same time, I think it's important for us to be realistic. Hence, the second part of the title, which is positioning for phase transitions, because there are transitions happening, and I think it's important for our strategy to take that into account and be ready to work around it essentially. So the structure of the presentation today, I think if anyone has attended any one of our presentations before, I think it's relatively familiar. We'll be talking a little bit about the global market outlook first, and then zooming in on the Malaysian equity space. And finally, I'll just talk about a few key funds that we have, just as a small act of promotion. Okay, I'll just kick things off with the global market review. So what has happened in 2021? So it has been quite an eventful year, but nevertheless, performance-wise, it has been really quite a mixed bag. To sum it up, we've had very strong performances from the developed and North Asian markets. But at the same time, you do have quite a little bit of drag when you look at the wider Asian space, and most in particular, the Hong Kong and Chinese equities. And ASEAN as a whole has been a little bit of a laggard, even though in select areas, we have seen most markets staying positive. Unfortunately, that hasn't really been the case for the KLCI, which is a negative 4%, and this is as of end of October. And but that that again doesn't tell the full story, as the small cap index has actually performed relatively well at double digits. But I will dive more a little bit into the local equity indices later on. Commodities have been another thing that performed well. We've seen CPO and Brent oil prices increasing quite significantly this year, together with a large number of other commodities. So I think it really shouldn't come as a surprise as these two key commodities perform as well. The ringgit has relatively held steady, and I think this is a factor that is going to be relatively important in gauging the rest of the outlook, especially when we move forward towards 2022. Now, in looking at the equity space in the past, we've always focused quite a lot on the COVID situation in most countries. And the thing is, we've slowly transitioned from looking at the number of infections towards the number of vaccinations and the vaccination rate. And I don't want to be jumping the gun, but we are, I think, getting to the stage where it's getting a little bit unnecessary to continually monitor the vaccination rate in most countries. As you can see, most of the developed world have vaccinated quite swiftly. In fact, on a global basis, even though you can see from this chart, we have reached roughly 40% globally. When you keep in mind the differences in certain laggard countries, plus the fact that when you only talk about vaccinating the more vulnerable adult populations, basically vaccinations have reached a little bit of a plateau at this point. So the story then becomes more about when can we see restrictions easing, and the most visible part for this is, of course, how soon can we see international travel resume. So once I think there is more confidence in terms of the vaccination rate of your neighboring and close by countries, you'll see more of these restrictions being removed, and not to mention restrictions made on localized spots. So we might see that some of these news flow relating to opening up come forth in the coming months as well. Like, for example, just Malaysia recently, we've talked about having preferential lanes with our neighboring countries. So without a doubt, I think this is a positive thing that we can look forward to. So now we delve into a few of the key geographies that I think will dictate, the pace of not just their own like local equity space, but also the global situation. So you can't talk about the global space without talking about the US. So what's happening there? First, GDP growth is actually still going relatively strong. I think you shouldn't underestimate the rebound of their economic performance. The third quarter figure just came out not too long ago, and it was 4.9%, which led to some people thinking, oh, whether or not are we moving towards a slightly slowing pace, since this has come off a pretty strong first half, which is typically like you saw double digit in the second quarter, for example. But I think we are still moving with a lot of base effects coming off the 2020 period. So a GDP growth of 4 to 5% in the coming quarters, as the street expects, is actually not a low number by any means. And I think there's a lot of positive factors to look out for. I think their labor market remains very strong. We've seen a wage growth hitting 4 to 5%. And we are talking about this is against a decent base where pre-COVID we are only growing 2 to 3% there. There's an inventory and capex life cycle still ongoing with some of their major corporations. And don't forget, during COVID period, the savings rate has been relatively high. So there is a lot of household income, or at least household cash flow, that can be deployed to keep their economic activity humming. And to talk about more recent news, I think the US government has just passed their $1.2 trillion infrastructure bill, I think end of last week. So it is a huge number, and I'm not just bringing it up because the number is huge. I think it's also huge from a relative point of view. Keep in mind the US GDP is only roughly $21 trillion, for example. So this sort of spending will continue to have its multiplier effect, and keeping up with some of these forecasted figures shouldn't be an issue at all. So now where do the risks lie? And this, I think, is probably where a lot of people have themselves seen in the news and probably pay attention to now. The most obvious of which is the rising rate of inflation there. So this slide is relatively important. We've mentioned here in September, their CPI has hit 5%. And this is quite a startling figure for most people who are used to the US reporting 2 to 3% inflation over the past number of years. And in fact, keeping below 2 has been a bugbear for most markets when we talk about the pre-COVID period. So, and in fact, I believe the print as of yesterday for October CPI was nearing above the 6% mark, in fact. So what does this translate into inflation? I mean, I've already mentioned that wage growth has been growing. So, the effect on consumers perhaps is not so startling. But the main risk, we believe, is actually that we start to see tightening of monetary conditions. And indeed, the US Fed had started to taper their purchases of assets as early as November by roughly 15 billion a month. And keep in mind, they were doing roughly 120 billion of asset purchases per month prior to this. So they have committed to this tapering just for the November and December period. And, they're still subject to changes as we move forward to 2022. And the important thing to keep in mind here is they have not actually mentioned increasing rates yet. But that being said, the market is being a little bit cautious. This chart here, it's a little bit tough to see, but basically what it implies is right now the market is expecting roughly one rate hike to come by the middle of next year. And in fact, up to 2 to 3 when we move towards the end of the year and 2023 instead. And this is coming off a pretty low base because keep in mind, the US has kept its rate at the 0 to 25 bips bound for the past couple of years, in fact, when we talk about dealing with the COVID period. So is this a major risk? On one hand, yes. I mean, the asset purchases have been a strong factor in encouraging the idea of a strong market liquidity, and this props up asset prices across the board, including equities. But one thing that gives us a little bit of comfort is the Fed has shown that it is market sensitive. I think they've talked about, wanting to regularize their interest rates, even, as early as a few months ago. But they are always quite aware of how markets have been performing. I think, you do have the occasional voices that claim that, the market is overheating. Given the such strong performance, I think over 20% in the S&P, perhaps it's time for a cooling. But with the market sensitivity that they have, we don't expect sharp movements to occur. That is to say that we might even see that the pace of tapering start to ease when it comes to January next year. So from that perspective, and keeping in mind that liquidity from the household and the corporate space remains high, I think it's too early to call this the an inflection point when it comes to market performance. But again, just relating back to the title of our presentation today, this is a change in phase, and we can expect that this won't be the only central bank to begin tightening its monetary policy. And in fact, once you move towards next year, middle of 2022, and as well as 2023, we may well see more tightening from most other sources, most other central banks. So how about the EU? What's going on over there? So growth in the EU has been, in a sense, one step behind the US in the fact that their GDP growth had peaked slightly later, almost by a quarter. And because of that, they're still showing relatively high economic growth for the moment. They just did, I believe, they're expected to do roughly 4% in Q3. But this is probably not the downwards trend, as it's expected to go as high as 5 to 6% in the coming periods. Now, economic activity in the Eurozone is perhaps not as influential as the US. And I think in terms of accepting the effect of rising costs, for example, increasing prices of oil and gas, I think the Eurozone performance is a little bit more of a reactionary. So from that perspective, we do pay attention to their PMIs, and this has started to slow in September. But at the same time, this remains in expansionary territory. So it's at this point not a huge point of concern. The other thing to pay attention to for the Eurozone is how the ECB, or the European Central Bank, performs. Now, they have, like the US, has had an asset purchase program, which they call the PEPP, Pandemic Emergency Purchase Program. And they have an allocated budget which allows the same level of purchases right up to March 2022. So even from a few months ago, I think there has already been somewhat of a finish line as far as the amount of asset purchases they can do. So the tapering could begin after that, and they've already talked about reducing the figure. But compared to the US, the ECB is slightly less influential when you think about how it affects the amount of the fixed income yield performances globally. And on the end, another key factor is because their interest rates are negative, unlike the US, a rate hike there is slightly less sensitive to most instruments compared to the rest. And another thing that I think should give us comfort is their preconditions for starting to hike rates is inflation as well. But inflation in the Eurozone is still not quite at the level that we've seen from the US. In fact, I think most recent readings there is roughly 4% on the headline level. But the core level, which is what the ECB pays attention to, is still roughly 2%, which remains their central bank target. Now, I think this is probably the more tricky region to deal with, which is China. So there has been a lot of news flow, and I think people paying attention to market can cite a large number of events that can, basically concern an investor. We've talked about, recent rises in new new COVID variants there. They have paused production in certain regions with outages of power. They've talked about some stricter controls on commodity prices. And of course, people are always afraid of market contagion. So the failure or near failure, I should say, of their property developer, Evergrande, it's certainly a thing to look out for. But I think beyond all this news flow, I think one thing people may not have seen is that economic performance has been on the decelerating path even from the start of this year. I think this is an important factor to note because this tying in together with these other factors is probably going to prompt a policy response, and policy is probably what we should be expecting to influence the performance of economic activity, trade levels once we move towards 2022. So as I've mentioned, GDP growth has somewhat slowed on a year-on-year basis. They are easing quite sharply from double digits in the first quarter towards roughly 8% in the second, below 5% in the third quarter. And even though people are still calling for an above 6% growth for 2021, we will see the low ends of 4 to 5% come the end of this year and the quarter, for example, quarter one of next year. And while earlier we've talked about the GDP growth rates expected for the US and EU of roughly similar levels, keep in mind China has always been expected to be somewhat of a leader as far as the economic growth is concerned. I think people are used to the 6 to 8% range. So staying below that for an extended period of time tends to be a little bit of a concerning point. So when will policy start to loosen again, where the Chinese government will try to induce more production, try to induce a regularization of more economic activity? We think it's still a little bit early to call, especially for this year. With the theme of common prosperity, there has been a large number, in fact, of policies implemented this year, which that has been a huge reason for the underperformance of the Chinese market. And at this stage, I think it's too early to call it complete yet. I think they're still waiting for the timing to implement some of these changes, especially where they can be seen as unpopular. And in fact, certain things, for example, the Evergrande company saga, is not yet complete. So, most of these things will take some time to resolve, and we do expect more firm policy direction to emerge as we move towards 2022. So end of this year or start of next year. And more importantly, we'll be looking for signs that more loosening will occur. Whether this is to encourage more industrial production or encourage reinvestment again. I think the form is again something to be seen. But for now, I think the news flow will continue to lean on the negative side. For example, due to the energy disruption, power outages in certain regions, do expect the PMI figures, the production figures, to ease as we move towards end of the year. And to round up the global view, what's happening with commodities? We've had a rather large jump in the number of commodities since the start of the year. And of course, most people attribute this to a recovery in demand. At the same time, certain production areas were still being hampered by COVID activity. And of course, in general, I think the theme has been decarbonization, where people's focus on more clean production or greener forms of energy has resulted in certain outputs being halted, basically for the foreseeable future. So we've had, huge spikes in things like steel, aluminium, and of course I've mentioned oil and gas and stuff earlier. So the thing to keep in mind is, will these hikes in commodity prices continue? And in fact, as early as third quarter this year, we've started to see most of a number of these commodities prices come down from their peaks. When you talk about the majors such as aluminum, steel, and coal, quite recently, a lot of them are basically quite far from the peaks we've seen in the first half of the year. And with now production capacity being resumed in many places, I think a runaway tear in commodity prices again is becoming a little bit more unlikely. And I think that's not even having to mention direct intervention done by certain parties. For example, China, which had released a large number of state reserves in the middle of the year, plus directly clamping down on coal prices just last month. So we've talked about inflation as a risk a little bit earlier. So in part, it is driven by these commodity prices. While they are no longer at the peak, it's still quite a good percentage higher than where it was last year, in fact, the years before. But a lot of the inflation currently is still driven by logistics and basically delays. So, we can look at the PMI of manufacturing delivery timing, and the fact that you've seen the global level dip below 50, in fact, I think below 40 as of recent figures, then in particular in the Europe and US, delivery timing, again, it is an index and they've fallen below the 20, the number 20. So this basically reflects the high cost of container shipping right now, the large delays that you see in shipping certain goods. So all this has translated into higher costs. But the good point about this, or at least the optimistic take, is all this can be resolved eventually. I think with even things like new shipbuilding, new container construction, it's basically a matter of time until these factors can be removed. So while people often quote the Fed's earlier statement of inflation being transitory, and then they reflect it against the high current level of inflations, and whether or not that seems like a mistake, the fact is it could indeed be transitory. I mean, inflation could hit very high levels, but what transitory means that is eventually prices will normalize. And I think that's kind of the key takeaway that we have, is that you should not expect prices to continue to go up continuously for that long. I think whether this cooling happens in first quarter or second quarter next year, again, that's still to be seen. But where beneficiaries of inflation are concerned, they should be a little bit cautious about projecting the good outlook when you stretch 1 or 2 years ahead. Okay, so to sum up our outlook for the global position, first, growth remains strong. I think this is of no question. 3, 4, 5% is actually a decent number for developed markets, even though the rate has come down. Second, fiscal policy remains strong. I think most governments are in the developed markets still trying to bump up local spending, bump up local infrastructure. So it is still stimulative, but monetary policy is the one that's going to be withdrawn or tightened a little bit earlier. So the US Fed in particular is seen as a little bit of a bellwether, but I think, as I've mentioned, given their market sensitivity, don't be surprised if rates do hold, on the low path for slightly longer. And while we do see the equity market being in a little bit of a period of consolidation, especially given the huge run-up, there is an occasional upside bias. I think the market still can be excited about good news. I think if a corporate is doing well, the market is still in a state to reward them. So there is an upside potential in that case. And I think this view is especially true for the US, but perhaps not China, where things are a little bit more risky. Now, again, then where are the key risks? Number one, supply chain issues. certain companies are affected more than others in this space. And this reflects ultimately in prices going up. Temporary or not, this can induce monetary tightening. And I think, make no mistake, we, like many others, do see this as basically an emergent risk. Now, policy tightening in China, you know, as I've mentioned, while we could expect a loosening in the coming periods, I think do not discount the fact that more unpopular or perhaps more strict action can happen in the near term. We've had such a large number of policy moves from China this year, and it's become quite difficult indeed to track where they may move next. And so from that perspective, I think it's still better to adopt a little bit more of a neutral stance when we talk about China. And as usual, I think we are still not completely out of the COVID phase. So if, let's say, there's a rise of new variants, even though we have now talked about having pills and stuff and new ways to manage the COVID situation, even though it moves to a pandemic, I think don't be surprised if, in very localized or small location or small areas, you can still see, strict lockdown measures being implemented. So again, this becomes more of a matter, how concentrated certain corporates are, how much risk they are exposed if they're limited to certain geographies. Okay, now I'll move on to our view on Malaysia. So Malaysia is rather interesting because there's a lot of positive factors to be excited about, but at the same time, with the recent announcement, especially from the government, I think there is room to be a little bit more cautious, especially where certain corporates or certain sectors are concerned. But before that, we'll talk about how the market has performed this year. I've talked about how the broader market is down. The KLCI is down 4% year to date. But at the same time, small caps have done well. I think small caps were up more than 10% as of end of October. Now, when we dive deeper into the sectors, who has done well? I think it's not much of a surprise. Tech and industrials, which indeed have been like the key outperformers over the past few years, in fact, continue to be the best performers for the local equities. And healthcare and energy is down. And while healthcare, especially when this includes gloves, perhaps it's not much of a surprise to the market. Energy stocks being down year on year, perhaps is still a little bit of a surprise. And I think this sort of highlights the importance or the growing influence of things like ESG investing is having on the local market. So, again, you'll see how this factors into our strategy view or positioning view later on. And the year-to-date performance does not tell the whole story. There has been quite a little bit of pockets of volatility. So we've had brief run in sectors like property, plantations, or even steel. So all in, while we are noticing that market average daily traded values have come off, I think the brief runs do tell us there is still potential for upside. So where a company is doing well or a company has strong outlook, don't be surprised if the market does reward them in the current scenario. So now we'll talk a little bit about the growth outlook for Malaysia, especially with the Ministry of Finance releasing their budget 2022 quite recently. And it's a good break that now we can talk a little bit more about the economic performance first rather than starting from COVID. So again, it's a good sign to show that basically perception and perhaps the mood has shifted somewhat. So where is growth going next year? The Ministry of Finance projects 5.5 to 6.5%. Modest, but I think still relatively in line. I think most of the street expect 5% and above. And it's going to be broad-based growth. as we'll dive into in the next slide. Now, the more interesting thing to note is the government expects fiscal deficit to ease to 6% from 6.5% deficit this year. Now, this is interesting because it basically shows that the government is comfortable with keeping our deficit slightly wider for a longer period of time. And I say this because we have the context of the other neighboring countries. Just to give you an example, Indonesia has also breached the 6% mark as of this year. But their government is talking about shrinking their deficit to the 3% mark as early as 2023. And hence, they're looking at sub 5% as early as next year. So the fact that the Malaysian government has put a 6% target basically tells you that they're okay with keeping spending a little bit higher. So again, from a fiscal support perspective, this is actually quite a good thing. So the statutory debt level should remain relatively high, I think still at 63.4% GDP end of next year. And another upside that we see from this is the oil price assumptions are actually relatively low. They're expecting $66 per barrel in 2022. And keep in mind, current levels are still above $80 per barrel. Now, a downside risk that they have noted are, basically should be to no surprise of anyone, outbreaks of new virus variants, volatility in global markets, plus any shocks from the commodity space. Now, where is the growth coming from? I've mentioned earlier that we're expecting kind of broad-based growth, but there's still a little bit of divergence which the investors should pay attention to. First, private consumption is expected to grow at above 7%. So this is a good reflection of going back to where Malaysian private consumption has typically grown, which is 6 to 7% in normalized periods. Net exports, they're only expecting above 4%. And this is, basically coming off a few years of good performance. And the key point of excitement is public investment, where they're expecting to grow 24%. So this ties into what I've mentioned earlier. Is like, don't be surprised if the government's fiscal spending turns out to be quite an important driver of growth and activity next year. Now we break it down a little bit more by sectors. Services expected to grow 7%. Again, this is tied very much or quite closely to private consumption, especially when you look at it historically. And the construction sector is expected to grow over 11% next year. And this is the continuation for a number of large or mega infra projects, which, their name should be no surprise to most people. But these are projects which progress has been quite slowed by quite a decent bit during the COVID period. Now, so the theme is starting to emerge, as you can see, is the impact or the influence of fiscal spending, of fiscal cash flows is going to be quite important next year. So we've talked about the growth aspect. So where is some of the money being spent on? And a huge part of it, which I think, ultimately is still a good thing, it comes to social assistance. Various forms of aid is still being budgeted. And I think, there's quite a number of small things to pay attention to. But I think a key factor that, some people should look at is the fact that they're expecting the Bantuan Keluarga Malaysia cash aid, basically, to come to 8.2 billion. So this is actually larger than the budgeted amount for 2021. So when you talk about B40's ability to spend, I think not to mention their ability to basically stay afloat in challenging conditions, I think the budget is clearly leaving enough room to ensure that the safety nets are still there. And then you still have things like smaller things like auto sales tax being expanded, some wage subsidies, microcredit here and there, and EPF contribution is still being kept low at 9%. Now, so where would some of these spending be financed from? And this is a factor that the market has taken relatively poorly. Basically, higher taxes. So, I'll just go ahead and talk about the headline thing, which is Cukai Makmur, or the prosperity tax, which I think has been very clearly designed to ensure that larger corporations, companies that are doing well, are the ones that are funding government spending when it comes to 2022. So this measure basically means that for companies who earn more than 100 million of taxable income, or pre-tax income, the tax rate will be adjusted to 33% versus the usual corporate tax rate of 24%. Now, there was a huge reaction, especially among the larger cap companies. A lot of them who might find it hard to avoid this measure because their earnings are in the billions, the range of billions, rather than just the hundreds of millions. And that's a 9% increase in tax. So the effect on your net profits is certainly going to be much larger than that. So the government was expecting up to 4 to 5 billion in net proceeds from there. And they have come up to clarify that perhaps it could be more towards the 3 to 4 billion range later on. But I think ultimately the message is quite clear that they aren't targeting specific sectors in this case anymore, where in the past people were concerned they would target, let's say, banks or the glove makers very specifically. Now it's in a sense a little bit more broad, where all companies that are making a large amount of profit. There's actually a lot that can be said about this topic. I think people were talking about the long-term implications for larger companies, or perhaps the fear of how this can impact foreign investment, where people are saying that if the government can do this once, why not one more time later on? But I think the pushback has been a little bit milder than expected. I do believe that the government has made some engagement with a lot of corporates prior to this, even though that has not been made very explicit. So for now, I think, long story short, most people do expect it to be a one-off. Then there's other things that can be seen as a little bit of a negative. Stamp duty has been increased for contract notes, and that does affect certain players such as Bursa Malaysia. Then there is several other taxes being implemented, such as money being remitted from foreign sources, or for example, this low value goods from overseas. So again, it's very targeted, but basically the whole story remains the same. You should expect fiscal spending and fiscal cash flow to play a larger part in how the economic activity of 2022 goes compared to the previous years. So where is the money flowing to? This is the key positive. Gross development expenditure is expected to jump quite significantly, in fact, by 22% to close to 76 billion ringgit next year. So I think while the market was a little bit disappointed that there were no new major infra projects announced, I think the fact that a lot of the ongoing projects will see their progress resume and basically potentially speed up, in fact, I think is a key positive factor to take, key positive note to take away from this. And finally, just to round up the view that the government could indeed spend quite a decent amount next year, Petronas did announce a special dividend, so their total dividends to the government is 25 billion. So this is keeping quite closely in line with the amount that the government has been receiving from them over the past couple of years. And again, with the oil price situation currently, don't be surprised if this figure remains on the high end over the next couple of periods. Again, a positive towards government spending. Now, I'll just round this up with a few major, economic indicators to look at for the country. First, inflation is basically not much of a risk from us, even though it has spiked somewhat to above 2% in recent periods. This is completely explained by the low base effects, and because of this, or perhaps in part due to this, we are expecting OPR to be basically kept whole for the foreseeable future. At least we do not expect it too soon over the next couple of months. Exports have been very strong. I think this story has run through for most of this year. And while the growth rate could somewhat slow next year, basically the key takeaway is exports remain on a high base level. And this is indeed true for the manufacturing goods segment, which has grown roughly 22% in September. I think this is a little bit more of an important indicator, despite things like agriculture or mining growing at above 40%, because keep in mind those are benefiting from the high commodity prices, whereas that manufactured goods basically showcases the strong level of demand that the Malaysian supply chain is enjoying at this current period. So both of this tie together to a strong or at least stable ringgit outlook. Our external reserves have been keeping at a very steady level for a long period of time, and our current account surplus has only grown. So basically, there's not too much concern of the ringgit weakening, despite the fact that people are expecting the US Fed to hike rates by the middle of next year. So this is a positive for basically a lot of the local corporates, especially those that rely on imported raw materials. Now we move to corporate performance. Corporate earnings were expected to jump quite significantly this year. Now this might be revised slightly down as we move towards the third quarter reporting period, which is ongoing currently. But in a sense, there is a little bit of a risk point when we look towards 2022, where the Cukai Makmur impact will be kicking in. And thus, while it's still early to call, I think early indications from most of the street analysts are looking at basically flat growth for 2022 instead. So where does this leave us in terms of positioning? Perhaps it's again time to be a little bit more selective, a little bit more cautious with your sectors. While you can dismiss the broader market as being hit by a one-off impact, I think the opportunity to select winners among sectors will continue to be a factor for next year. And I think this is probably where a lot of the base optimism for most people lie, which is foreign flows have been starting to return to Malaysia. So we've experienced 3 straight months of foreign net buying since the month of August. And in fact, November figures are still showing strong. So on this chart, on this slide, I have said that there was net inflow of 1.6 billion in October, and the net foreign sell for 9 months of 21 was close to 2.2 billion. With the inflows we've seen so far in November, of course the month is not yet over, but we've already reached, I believe, a net positive inflow. And this has been a factor that is pushing up, both local markets as well as other ASEAN countries. So what's the other positive takeaway from this? The foreign shareholding level in Malaysia remains very low. In fact, it's still 20.5% as of end October, despite the fact that foreign buying has returned. So, when we think of, in the past, we can hit 25% foreign shareholding level. I think basically this just goes to show that the foreign flow effect may still be a force to come and help the market when you think about performance moving into next year. Rounding up with, of course, a risk factor that we are always very concerned with, which is political uncertainty. Now, I think, in the news recently, people are more concerned with the upcoming state election, especially in Malacca. But if we take a step back, and especially when you look at it from a foreign investor point of view, the timeline is a little bit more set, because currently the understanding is no parliament dissolution will be happening until end of July 2022. But again, that basically gives you a little bit of a line in the sand showing that, where there may be shakeups in the government, it may still happen by the middle of next year. So in some sense, this risk has been postponed. But on the other hand, for those with a longer investment horizon, or for those with, taking a longer view when it comes to local investment, this timeline may prove to be a little bit of still a factor of uncertainty. Okay, just to sum up again, what our view for the local market is. First, economic growth is going to rebound next year. I think that's, again, due to the low base effect, reopening, plus the fact that we can expect fiscal support or fiscal spending to come in stronger. The second point here is fiscal influence is significantly higher. We are seeing higher taxes impacting the corporates, and thus this cash flow is again at the behest of the government to spend. And where there is potential upside risk in terms of infra spending, development expenditure, these are things to be paying attention to when it comes to the government budget next year. The external sector, basically talking about exports, is expected to remain strong, especially in the manufacturing space, not to mention the E&E sector. And foreign shareholding remains low, even though the reversal in foreign flows have already begun. And basically the hope is this reversal will continue to take hold. And the key risk, again, is nothing unusual for our market, politics. And of course, whether some of the developed markets tightening will happen a little bit sooner than expected, because the sentiment locally, especially in recent times, still remains quite jittery. And just to give context of where Malaysian stock valuations are, keep in mind Malaysia has always been seen as a little bit of a premium valued country, especially in the pre-COVID periods. Malaysia remains the second cheapest market in ASEAN as of today, trading well below its average PE ratio at below 16 times. Okay, so this we are rounding it up with probably the most important slide that we have, which is our strategy slide. For anyone who has seen any one of our presentations before, this is probably not new to you. So we have adopted this strategy and it's done well for us. And at this point, essentially, we do think this strategy remains very valid, which is what we call the Barbell Strategy. So basically, it's important to have weights in both, the two diverse ends of this factor. One being the recovery theme, so where the economic reopening is expected to benefit a number of sectors. So we've laid them out here, including financials, some commodities, a lot of consumption, including travel, retail, leisure, and some value plays, especially within the construction, property, or even infra space. But at the same time, the other end of this barbell is some of the circular growth trends, some of this basically multi-year growth stories that at this point remain intact. So we are talking about things like various kind of tech exposure, trade diversion. Malaysia remains quite a popular place to reroute new production, renewable energy, and again, ESG. I think this remains an important trend that is becoming increasingly important. Okay, just to finish off before we move to Q&A, I'm aware I'm a little bit over time, so I'll just, if you allow me, I'll just talk a little bit about our key fund performances this year. I think generally speaking, our funds have done relatively well. We're up double digit, especially for most of the local focus funds. But where I'd like to direct your attention to is probably more the 3 to 5 year performance. Because I think ultimately for Kenanga investors, we are aiming to outperform on a long-term basis. Basically, the market, can go through very significant periods of volatility, especially in recent times. But the key thrust of our strategy, end of the day, is to make sure over a long period of time, the outperformance is still there. So I think, when you look at the 3 to 5 year performance, basically this strategy has helped for us. And just to finalize by highlighting our flagship, which is the Kenanga Growth Fund, I think it's done relatively well. And again, just to highlight, it has gotten decent number of accolades from things like Morningstar as well as Refinitiv. Okay, so that sums it up for me. Happy to take any questions you may have. Thank you.
Thank you for the insightful presentation, Marvin. Okay, so I will read out to you the question that the attendees is asking. So the first question: if China is restricting production of steel price should continue to be firm at or higher. Why is steel price going down? What's your view on steel players in Malaysia?
Okay, that's quite a good question and quite topical, since I think, as most people are aware, the steel names had a bit of a run up and then subsequently came down. So first off, to clarify what's happening in China, they are not outright banning steel. They're actually banning very selective areas in production, in steel production plants where it's deemed to be basically a larger polluter, or perhaps using more unclean sources of energy. So this has sliced production, but not completely. In fact, I think, it's hard to get an exact figure, but I think people are ballparking anywhere from 20 to 40% of their potential output being cut. So now why isn't basically, why are steel prices, in some sense, after a little bit of correction, still holding, or perhaps, why could it be trending up? Is the fact that, China, while they are important, they are not, on a global basis, they do not corner the production or consumption of steel. So when we talk about the local steel players, the truth is most of them are still seeing significantly higher prices for their end products versus many years prior. And their feedstock, their raw material, are in fact still lower. So from a fundamental perspective, actually a lot of steel players do not be surprised if their performances remain very strong when you talk about earnings in the coming period. So from that perspective, while we can see sentiment leading to some of them being sold down, if this good financial performance continues, and we do expect that moving even towards fourth quarter or first quarter next year, I think don't be too surprised if there's a little bit of a reversal.
Okay, we proceed with the next question, Marvin. It's stated here, what is the reward versus risk of Hong Kong technology sector for the next 12 months? As you know, there's a major correction due to crackdown of China technology and e-commerce companies lately. This is for your opinion.
Sure. Okay, at this stage, I think from a fundamental perspective, I think there's no question that a lot of the tech companies, especially when you look more towards the platformers, a lot of them are looking cheap. And a lot of them, basically, they've come to multi-year lows, especially when it comes to valuation. Now, the risk to reward, so certainly the risk remains still high at this period because people are still concerned if many of them are subject to some sort of policy or regulatory change. So from this perspective, I think timeline-wise, people are still worried about additional measures being implemented by the end of this year. And you do have to be selective on some of the tech names to which space they are exposed to, while those more involved in hardware, because when you talk about Hong Kong, China, there are still a large number of, let's say, hardware producers. They are still benefiting from multi-year circular growth trends. I think the volume performance will still remain high, as long, of course, as they are not hit by raw material or supply chain issues. But for tech names relating to platformers, so this one that needs to be a little bit more concerned or at least a little bit more caution when investing in them, because basically when it relates to platform, then you're also a little bit concerned about the kind of content and whether that content may need to be regulated. Yeah.
Okay, thank you. Okay, since we almost ran out of time, so we take the last question. Is almost the same like the previous question. The attendee would like to know, when do you believe the current China turmoil, the Evergrande regulatory focus will stabilize?
Okay, yeah. So that is a very important and indeed, as people like to say, the $1,000,000 question. So I mean, Evergrande is probably just one part of the story. As we've talked about earlier, for their case in particular, they still have a number of debt obligations to meet by the end of the year. And while there is ongoing debate, would the government step in to more actively try to avoid a full default? Would the government step in at any point, in fact, to have a white knight come in? I think there's still going to be debate on the particulars, but what the more predictable thing is, a lot of their events or a lot of their trigger points will still happen in stages towards the end of the year. So from that perspective, when we talk about November, December, at least this couple of months, basically, timing wise, it's still a little bit risky to basically call a very direct or very how do you say, a very outright positive view on either them or any sort of other Chinese exposure. Basically, at this stage, still a lot of bad news can happen, and where the market has taken quite a significant beating over the year already. Initiating fresh positions now where you're still at risk of basically new negative developments can still, basically it's still quite risky at this point.
Okay. At the moment, currently, that's about the time that we have for tonight's webinar. So if you have a further question, feel free to send us an email at investhelp.my and fundsform@fundsform.com. And then a replay of today's session will be available right after this. Head over to our YouTube page at FSM1 Malaysia to catch this replay. Once again, thank you very much, Marvin, for joining us today. And thank you everyone for attending tonight's session. So by this, I will end this webinar. Take care and stay safe.
Thank you.